Good morning. Today we are initiating a deep dive analysis on Palo Alto Networks, ticker PAN, ANW. As the cybersecurity landscape shifts from fragmented point solutions to integrated platform architectures, PANW has emerged as the apex predator. Our thesis rests on three pillars. First, the successful platformization strategy, which drives vendor consolidation. Second, the aggressive expansion of next-gen security, or NGS, ARR. And third, rigorous discipline in GAAP profitability and free cash flow generation. While near-term billings volatility has spooked some retail hands, institutional data suggests this is a friction cost of transitioning to long-term recurring revenue models. We view the current valuation as a premium entry for a compounding asset poised to capture significant share of a $200 billion TAM.
Let's dissect the core strategy, platformization. The enterprise C-suite is suffering from agent fatigue. Managing 50 different security vendors is no longer viable. PANW is capitalizing on this by incentivizing clients to consolidate onto their three core stacks: Strata for network security, Prisma for cloud security, and Cortex for security operations. By offering fee-free periods to displace competitors, PANW is taking a short-term hit on billings to lock in long-term customer lifetime value. This is a classic land and expand maneuver, but at an infrastructure scale. We are seeing multi-module adoption rates climbing, which creates an incredibly wide moat against single-point competitors like Zscaler or CrowdStrike in specific verticals. The macro tailwinds are undeniable. We project the global cybersecurity TAM to expand at a 12% CAGR through 2028, but the specific subsectors PANW targets, specifically SOC and cloud security, are growing at nearly double that rate. With the proliferation of AI, the attack surface for enterprises has grown exponentially. Generative AI is a double-edged sword. It empowers attackers, necessitating AI-driven defense, which Cortex provides. We are modeling PANW's serviceable market to exceed $110 billion by 2025. In this environment, scale matters. Only players with massive data lakes, like Palo Alto, can effectively train the AI models necessary for real-time threat detection.
Investors must distinguish between billings and RPO. Billings have shown volatility due to PANW's strategic decision to offer deferred payment terms and the platformization incentives mentioned earlier. However, the remaining performance obligations, or RPO, remains the superior metric for gauging future revenue health. RPO growth has remained robust, signaling that demand isn't evaporating, it's just being structured differently. We are looking at an RPO approaching $12 billion. When you strip away the noise of financing adjustments, the underlying booking momentum remains in the high teens to low 20% range, which is highly attractive for a company of this revenue mass. This is the single most critical KPI for this stock, NGS ARR. This metric isolates the growth of their modern portfolio, Prisma and Cortex, stripping out the legacy hardware firewall business. We have seen NGS ARR grow from under $2 billion to surpassing $4 billion in a remarkably short window. This aggressive ramp proves the market is accepting PANW, not just as a hardware vendor, but as a cloud-native security partner. As NGS becomes a larger percentage of the total revenue mix, the company's valuation multiple should expand, as software revenue commands a higher premium than hardware revenue.
Moving to the bottom line, PANWS has matured. Management has strictly adhered to GAAP profitability, a milestone many peers in the cyber sector still struggle to reach. But the real story is free cash flow. We are observing FCF margins pushing towards the 38–40% range. This is elite territory, complying with the Rule of 40 with ease. This cash generation allows for aggressive share buybacks and organic R&D funding without dilution. In a high-interest rate environment, this self-funding capability acts as a defensive floor for the stock price.
Contextualizing PANW against the peer group, we have Fortinet, FTNT, Zscaler, ZS, and CrowdStrike, CRWD. Fortinet competes on price and hardware performance, but lags in cloud integration. Zscaler is a pure-play proxy, but lacks the network firewall heritage. CrowdStrike dominates the endpoint, but is trying to move into network. PANW is the only player with a fully integrated code-to-cloud platform. While best-of-breed solutions have their place, the TCO, total cost of ownership, argument favors PANW.
CIOs want fewer dashboards, not more. PANW's ability to cross-sell SASE to existing firewall customers is a leverage point no other competitor possesses. Valuation. PANW typically trades at a premium, often between 40x to 50x forward earnings, or roughly 25x EV/FCF. While optics suggest this is expensive, one must adjust for the growth-adjusted PEG ratio. Given the durability of growth and the FCF margin profile, we believe a premium is warranted. Relative to pure cloud peers trading at 10 to 15x sales, PANW offers a reasonable GARP, growth at a reasonable price, entry. Our model suggests that as long as NGS ARR growth sustains above 30%, the multiple will hold. We value the stock using a blended approach of DCF and EV/FCF multiples. We must remain objective and consider the bear case. The primary risk is execution failure on the platformization strategy. If customers accept the free incentives but refuse to renew at full price, margins will compress without revenue growth. Second, macroeconomic pressure could delay large enterprise CapEx deals, extending sales cycles. Third, the cybersecurity space is fiercely competitive. If a new AI-native disruptor emerges, PANW's incumbent status could become a liability. We are also watching insider selling patterns closely, though currently they remain within standard executive compensation norms. In conclusion, we rate Palo Alto Networks as a long-term buy. The company is successfully navigating the most difficult transition in tech, moving from hardware to software while maintaining profitability. The platformization strategy creates sticky, high-value relationships that competitors will struggle to break. With a path to $100 billion plus market cap and best-in-class FCF generation, PANT remains a core holding for institutional cyber portfolios. We anticipate volatility, but the structural trend is upward. We are setting a 12-month price target implying a 20% upside from current levels.